prep your investors in advance. We did not do that. We went from 212 units where we raised 150K to having to raise $1.5 million. For us, that was a huge kick in the butt. I eventually got it done. If we had started by prepping them in advance, using that right deal structure up front, it would have been a lot easier.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And Point Central, the leading provider of enterprise-scale smart home automation for short and long-term rental property managers. Learn more at pointcentral.com. Hello and welcome to episode 111. My guest today, David Toupin, is a syndicator of multifamily and apartment investments based out of the Detroit area in Livonia, Michigan. His company, Borland and Toupin Holdings, owns and manages a $6 million portfolio of 120 units, and it also does single-family fix and flips. David is also the host of the Borland and Toupin Real Estate Investing Podcast, and today he and I are definitely going to be talking about apartment and multifamily syndication, and David even has his top 10 tips on successful syndication. David, welcome to the show.
Absolutely. Thanks, Brian, for having me on. Very excited.
Yeah, thanks for being here. So I always like to start with the question, how did you get involved in real estate, and what was going on in your life before that happened?
Absolutely. Yeah, that's a good place to start. So, right now I'm 22 years old. I started when I was about 20 in school, and I'd done some internships in auditing, consulting, investment banking, and, really got a taste of the corporate life. And for me, that really didn't, that didn't tick for me. That wasn't what I wanted to be doing. Since I was 13 years old, I've been an entrepreneur. I ran, my first business was a landscaping business. I built that up, sold that off at the end of high school. Going into college, I tried some other tech type businesses. But really, I'd always had an interest in real estate investing. I had some relatives that were pretty successful developers, and I saw what that did for them. And I've always had some substantial income goals that I've wanted to hit. And for me, it was like, it clicked. Like, real estate investing, I can do this. And, seems like really anyone can do it if you work at it hard and long enough. So for me, while I was actually doing one of these internships and still going to school full time, I got my real estate license as an agent, never with the intent to act as an agent, but I wanted to get it so I can get into stuff like wholesaling, fix and flipping, and the whole shebang there. So that was kind of my goal. So actually, the day after I got out of my final internship is at a Big Four consulting firm. I had that full-time job offer and another job offer too. These are six-figure job offers. I called them all up the day after I got out of that last one, and I turned them all down. Or I called up one, the other one I met with people. I turned them all down. I was like, if I'm going to go and do this, I need to cut the cord. I need to go out on my own. I'm young. I'm 20, 21 years old. I need to put myself in a corner, and that's really going to push me to be able to do this. So that was a huge leap for me. I ended up getting right into wholesaling, single family. And long story short, I found a local rock star who I was like, I see that guy's doing a lot of big things and what I want to do, fixing and flipping. And I met with him. He ended up having me work for him in acquisitions. I worked my butt off and totally over-delivered on value. We did really well. Actually, our last month, it was December 2016 was our last month. We had bought 16 properties to fix and flip, we do a light flip and put them back on the market. Before that, my partner, Dylan Borland, who's my partner now.
He's the rock star?
He was the rock star, yeah. So he was doing about 100 fix and flips a year for the past 5, 6, 7 years. He's 31 now, and he started when he was 17, kind of, started fix and flipping, buying rentals, whatnot. So he took me under his wing. and we decided after doing, I was with him for 5 or 6 months doing these fix and flips. I'm like, when you're fixing it and flipping, you're working a job. You're an entrepreneur, but you're working a job. You don't have if you stop doing that, 3 months down the road, when your turns, your flips are done, and you get those sold, your income stops if you stop working. That's not what we're in this game for. We're in this, and you're probably in the same business as well. I'm sure a lot of your listeners, you want to build passive income. You want to build, possibly generational wealth. You want to be able to take a month or two off when you've got your business established and have, still have income coming in every month and not have to worry about it. Right. So, we talked and I said, hey, let's get into multifamily. A lot of people are doing this multifamily stuff now. It's real hot, and they're doing syndications. So, we cut the cord. The same thing, I guess that common theme will come up. We put ourselves in a corner. We said, let's stop fixing and flipping for now. Let's master the syndication business.
Great. Well, I think it's important to just illustrate here that you are obviously a go-getter. I mean, you've been a go-getter since probably before high school, which is what helped propel you at the age of 22 to say, I don't want a job. I'm going to do real estate full time and not have any steady income. Now, I will say this, any listeners out there who are around that age and thinking, oh, good, I'm going to do the same thing. I would just say this, that at the age of 22, if I had said that, I would probably be sitting on a couch on a curb somewhere eating a bag of Doritos, because I was not as much a go-getter. So I think you have to be a very, very specific type of person to make that sort of decision so early on in your career.
Well, I think if you what it is for me, I think, and it comes down to self-awareness, right? And if any of you guys listen to, I don't know if you know Gary Vaynerchuk, Brian. Have you heard of Gary Vaynerchuk?
Sure, yes.
He's a huge, social media personality now. He always talks about self-awareness. And I think for me, it came down to, I knew what I wanted in life, and I'd seen so many examples of people that, and there's nothing wrong with it, but that have, waited, they worked in a job, they waited till they were 30, 40, and then they went into it, which is still a great way to do it. It all depends on what situation you're in. But for me, I'm like, I have a chance to do it right now. Why don't I try? I don't have a lot to lose. I don't have a family. I don't have kids. I don't have, a mortgage to be paying for. Like, for me, it was kind of an easy decision, because it's like, this is what I want. Why don't I just work hard to get there? And, it makes it sound easier than it is, but, the 80 to 100-hour weeks I've been putting in for the past 2 years, really is what makes it come to fruition.
Yeah. So let's skip ahead to the punchline here. Is it working out for you? Are you at a point now where you're making the kind of money you would have made had you taken on one of those jobs that you've been offered?
Yeah, well, yes and no. So I would say no, because I live very minimally. I pride myself on living under $2,000 a month is my budget, and everything else that I make in our business, between me and my partner's similar. We put everything back into the business. So we get on our last deal we got $120,000 syndication fee. We each took $10,000 for ourselves and put the rest back into the business. We want to escalate our growth. We want to put that on steroids. And right now I don't need to be fancy going out, and I don't need to make six figures right now. I don't need that. It's not the time of my life. I want to grow the business. So right now, after the past 9 or 10 months of doing syndications, we've done 2 12 units. Those were our first 2 deals we did. Had plenty of lessons learned on those 2, to say the least. It was a great learning experience. And then we just closed on a 96 unit just three months ago now, in September of 2017.
Wow.
So and that's awesome.
Let's get into those then. So you decided real estate. That's the way you were going to go. It sounds like with Dylan Borland, you started doing the fix and flips, decided, hey, this is great, but we're getting paydays as opposed to cash flow.
Exactly.
Let's start investing in multifamily. Where did you take it from there? That was your thought. Let's invest in multifamily. What did you do next?
Yeah, I guess, yeah, that's really important to go back to the beginning. Why did we want to do that? So like you said, we wanted the cash flow, the passive income. And then from there, we thought what everyone else thinks, and I'm sure a lot of your listeners, like, what do you do? How do you start? So we started basically like we did the fix and flip side of the business was a lot of prospecting. We're old school. We really, we like working with brokers, but we also like finding our own off-market deals. So what we do is we build out a list, and we use CoStar. If your guests are familiar, CoStar, they own apartments.com, LoopNet, and you can subscribe to them, and they'll give you data on all commercial assets, commercial real estate, on or off market, in any location that you decide subscribe to. So we built out a list.
Right there, because I subscribe to CoStar as well.
Yeah.
Right there, you've just illustrated a point that you're paying, because it costs over $2,000 a year to subscribe to CoStar, depending on your area.
Depending on the area, correct.
You're in the Detroit area, so you're probably paying more than me.
We're like three. We do actually all of Michigan, but we have our own brokerage. So I think they give us a deal because we have a real estate brokerage.
Okay.
So it's like $325 a month for all of Michigan.
All of Michigan. Okay. Yeah, I get like mid and west Michigan. So
Gotcha.
Anyway, but my point is, that's a serious tool for serious commercial investors.
Yep.
And the fact that you and your partner are willing to make that investment and have that tool at your disposal, it shows how serious you are. So anyway, continue. I just wanted to make that point.
No, that's important. Yeah, it's a serious, it's a serious step, and for us, we wanna roll with the big players, and that's what they do, that's what they use. So we took that step. We basically outlined our criteria. We didn't have a lot of experience. I didn't even know what an agency loan was. I didn't know you can get a Fannie Mae, Freddie Mac loan. So we ended up getting these 2 12 units, which were from brokers, actually.
Were they separate 12 units?
Separate, correct.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. Take us through the first one. What was the first deal you did when you decided to jump over to multifamily?
Yeah, so, I got to think back. So we found it through a broker. It was actually both of the 12 units, they're on the same street. It was funny. They're listed by different brokers, but they're within a quarter mile of each other. So for us, we're like, okay, there's 2 12 units here. We analyzed, ran the numbers, which is a little more primitive analysis than we do now. I take that upon myself to run the numbers because I come from a little more financial accounting background. We did that. We determined, we started listening to what's a common syndication structure to use. So we ended up doing 8% preferred return, 80-20 split over that. So I don't know if you want me to break that down, how that works.
Yeah, let's break that down. So 8% preferred return, 80-20 split. What does that mean?
Yeah, so basically we're going to take whatever the total invested capital is in this deal. For this, let's just say, for an example, let's say $100,000. 8% is the preferred return. So 8% on that total invested amount, 100,000, so that's 8,000. The first
that's for your investors, the investors
Correct.
that are bringing the equity to the deal.
Correct.
They're going to get an 8% preferred. Is that guaranteed, or is that only if you make enough to pay them that amount?
So it's not guaranteed, yeah. So it's only if we make enough to pay them that amount. So we go into a deal and we say, okay, so the first $8,000 that this property makes every single year goes to the investors. and then that split comes into play after the fact. So once you hit over that 8,000, every dollar is split 80% to the investors and 20% to the sponsors or ourselves, our firm. So, when we look at a deal, I'm going to say worst case scenario, can we hit this 8% benchmark? Because really what we're pitching to investors and what we want to get them is like a 10 to 12% annual return. Especially because we didn't have a huge track record. It's, we want to be able to bring them a better deal because they're taking the risk of working with somebody who hasn't done that before, who hasn't managed. We've managed single family rentals. We had about 100 plus single family rentals at one time. It's a different story, total headache. So that's kind of the deal structure.
So you and I are both syndicators, so we both know the answers to this, but I want it to be as clear as possible for our listeners.
Yes.
You mentioned the annual return. So you're offering an 8% preferred return, but then you mentioned a 10 to 12% annual return. What is that?
Yeah, so the annual return comes into play when you have that 80-20 split. So let's say, for example, I said we're going to get them to $8,000, which will get them up to an 8% benchmark. We're going to want to make sure the property is overall making $15,000, $16,000 net a year. And then that difference, that $7,000 or $8,000 difference, is going to be split between us and the investors. So if they're going to get their, just do some quick math, 80% of the $8,000, they're going to get that extra $6,400 on top of their $8,000, and that'll put them at a little over $14,000 or a 14% return.
Okay.
If that was explained.
And this is assuming that you raised a total of $100,000.
Correct.
Because you're putting it in dollar amounts, but if you assume $100,000 total investment, then it breaks down to that same amount in percentage as well.
Yes, absolutely.
Okay, so that's a little different than the way I've always referred to. Well, I guess you're calling it annual return. So you're saying it's a preferred return. So at a minimum, your investors should hope to get, and it's not guaranteed, it's just projected, hope to get 8%. Mm-hmm. But what you're striving for with the annual return is that they would get up to 12% a year.
Correct. Yep.
Go ahead. Sorry.
No, I was going to say, so it might make more sense the way we lay that out is we do a 2% quarterly distribution. So 4 2% distributions, that adds up to a total of 8%. That's the preferred return. And then at the end of the year, we sit down and say, okay, let's set aside reserves that we need. Let's, take of what cash we have left. Let's set aside reserves. Let's make sure we have enough to continue covering our monthly cash flow. And what's left over, and then let's use that as our pot of money to split up to the investors. They get their 80%, we get our 20%. And that's how we earn a little bit of income. We get that extra, as a sponsor, we get that extra chunk at the end of the year, along with our management fees we're getting throughout because we do self-manage.
Let's talk for a moment about Point Central, the leading provider of enterprise-scale smart home automation for short and long-term rental property managers, and how their exciting technology can help you control property access to vendors and potential tenants. No more time wasted waiting for late appointments or no-shows. Oversee energy usage and analyze data in order to reduce utility and maintenance expenses. Eliminate the cost of keys or rekeying locks. Command higher rents and increase tenant retention, and provide tools for tenants and managers to monitor the property to improve safety and security. And it's all done through cloud technology, utilizing encrypted data and private cellular service. And best of all, the return on investment of installing Point Central's technology is upwards of 25% a year. The future of property management is here, and you can find out more by visiting pointcentral.com. Okay, so you're paying yourself separately as the managers of the property.
Correct.
Gotcha. So going back to the preferred return, annual return, what about when you sell the property and take the profit? How do you display that to your investors?
Yep. So the equity split on the property, or the ownership interest, is split exactly the same as that 80-20, what they call in the industry positive alpha, or I don't know if you have is there another term for that?
No.
That
I don't get that fancy. I just say it's an
no,
80,
that's okay. Yeah,
80-20, 50-50 split, whatever it might be.
Let's keep it simple.
Yeah.
That's split. So we're going to split it on the same exact method. So what we're going to do is if we sell the property, which is the goal for these were a 3 to 5 year term with some value add. We're going to pay back, obviously, the mortgage, pay back any closing costs with the proceeds from the sale. Then the next funds is called a waterfall. The next funds are going to go towards paying the investors back their full capital invested. So that entire 100,000, let's say, they're going to get their 100,000 back, plus any accrued preferred return. So what that means, guys, is if you miss any distributions or if you can't make that 8%, that actually accrues every year. So, if we don't hit that benchmark and we do end up selling this and making more money on top of paying the investors back their initial investment, they do still get up to that 8% that we promised.
Okay, so it's
right?
so in a way it is somewhat of a guaranteed 8% return.
Somewhat,
because it accrues and will be paid back upon sale as long as you make enough money to pay it back.
Absolutely. Correct. So they'd get that back next. And then what happens is any remaining proceeds get split 80-20. So they're going to get a chunk of the profits at the end as well.
And do you make projections based on that return at the point of sale?
Projections based on the extra profits at the end?
Yeah, so everyone does it differently. And the way I usually refer to that is the annualized return, where once you add up all the cash flow they've received each year plus their profit at sale, you divide that by the number of years that they were in the deal. That tells you how much money they actually made each year.
Correct.
And what the return is each year.
Yeah. So, and everyone does it a little differently. There's a lot of different financial metrics you can use. What you're referring to, as an annualized return, you're basically taking the total amount of money they've been paid out or returned over that period, and you're dividing it by the number of years there, and you're kind of going to get an annualized cash on cash annualized return, and that's definitely what a lot of people use. Something else that investors will use is an internal rate of return, or an IRR. And guys, if you're not familiar with that, I would maybe do some research into that, because that basically is a metric that shows the growth rate of your capital, which is important. And you'll see that in other financial, in stocks, stuff like that. Do you use IRR, Brian?
No, I prefer annualized return because it's straightforward. The IRR takes into account it discounts for the time value of money and net present value and all that, and it just it's too confusing. And from a marketing standpoint, it lowers that actual overall return.
Yeah. It does, It does lower the overall actual return. So, if you let's say, for example, if you're going to look at an annualized cash on cash of 18 to 20%, you might have an IRR of 14 or 15%. And that's kind of showing what's the growth rate of your money, as opposed to just a standard cash on cash. So, and both are used, depends on the type of investors you're talking to and working with. Some investors will come right up if they're sophisticated and say, hey man, what's the IRR of this? I want to know how fast my money's growing, because they're looking at other investments with the same metric, right? And it's standardized so that they can say, okay, I can put my money into a stock at a 16% IRR, or I can put my money into real estate at a 20% IRR, and they can compare, across industries as well. So,
I have well over 40 investors, and they're all accredited, and no one has ever really focused on that IRR. They seem to be perfectly happy with the annualized return because frankly it's just easier to understand.
Sweet. That's how you want it to be. Trust me. You don't want to. Yeah, you want to keep it simple as possible. And I was going to get into a little bit of that when we're going over some things that I mentioned to you. But it is important to keep it simple as well. And if you're not dealing with people that want to know about it, leave it out. Don't tell them about it. They don't need to know what the IRR is. Tell them the annualized cash flow.
Yeah, I mean, we've both done 3 syndications so far, and I find that most people they want to understand in the most simplest way possible. So
100%.
And I have 20 years in marketing, movie marketing, and we would write copy, and we would always just have to simplify, so that it's crystal clear exactly what people are getting into, or what we're selling, what people are going to get out of it. And so when I put together a property package, I want to make it as clear as possible, which means making these very complex equations and terms like internal rate of return, annualized return, something that people can understand in a paragraph.
Yep, 100%. I agree with that. Yeah, you've got to. Guys, we're dealing with people that you may be in these pro formas, looking at them every single day, day in and day out. When you're analyzing a deal, you're in the industry, you understand how all this works as a sophisticated investor and sponsor. The investors do not always know all that. And so it's important for you to not confuse them, because trust me, and we'll talk about this, we've lost investors because we gave them too much information.
Absolutely.
And that's a real thing. So
a confused mind says no.
Exactly. Yeah. Seriously, they get you get a little defensive and you don't understand what's going on. Your natural response is to say, hey, I don't want anything to do with it because I don't understand it. Yeah. So.
And you tend to find that when you get commercial brokers and they put together packages, they include a lot of those ratios and internal rates of returns and net present value. And it's a lot of noise. I mean, there's some very straightforward numbers you should really be looking at when you evaluate these things. And I don't know if you're the same way, but when I analyze, I tend to ignore, at least in the beginning, I tend to ignore as much as possible of the information that's being directed toward me and really just focus on the basics.
Absolutely.
That, help me kind of cut through the clutter as to whether this is a good deal or not.
Absolutely. Yeah. I mean, I mean, personally, I don't look at really anything in the broker packet for too long. I'll take a quick glance. I don't ever use their performas. I always create my own. What I need is a T12, which is past 12 months of operations.
Trailing 12-month report.
Yep.
Yeah.
Yep. Trailing 12, and then a rent roll. And that's all I need. And I do like to see 2 to 3 years. So if I can compare 2015 to 2016, I can say, okay, well, why did they spend? Why did this go up in this year? Why was this reduced? Why did they hire paid security now this year in 2016 as opposed to 2015? Is there crime rates that have been growing in the area? You can start to infer stuff. So but that's a whole different.
Well, exactly.
Analyzing a deal is a whole different topic.
The numbers tell a story. I mean,
they do.
You see numbers that raise questions and lead to an interesting story. Did you get any training for this? Take any seminars or training?
No,
on syndication.
I started when I was doing some investment banking. I started because all we do all day is play in Excel. You're in Excel sheets. You're in these giant 20-page Excel sheets. I mean, it's super complex. So I was like, well, I was starting to look at deals on LoopNet on the side, like I'm sure a lot of your listeners might have started doing. So I put together an Excel sheet, a pro forma, and just started analyzing. One of the partners at the firm owned a few small apartment complexes. So I was like, hey, you mind if I run this by you and you can kind of teach me a little bit about how the numbers work? So he did that. Other than that, formalized training, I taught myself everything. I mean, I just started looking at just dozens and dozens and dozens of deals, and I tracked all that. And I think I looked at like 125 deals to be able to get those first 2 that we bought, the 12 units. So that's like, what is that, like 60 to 1 ratio of deals looked at to deals purchased. And I would go through and just run the numbers, throw it in the pro forma, learn what, look like what you said, those numbers tell a story. I would practice and practice and practice. Like anyone that wants to perfect their craft, you're going to practice it. So I did that, and then continuing on to get into this next deal, I learned a lot. We started to see, okay, what did I do to analyze these 12 units that now I'm seeing is different? I didn't take into account because we went to a local regional bank. You can't get an agency loan we bought these each for about $550 a piece. And you can't get an agency loan. So I didn't take into account that along with your principal, interest, and you're paying taxes in that loan payment every month, they actually add in a percentage on top of your taxes, and they're taking a few extra $100 out a month to cover any adjustments or changes in taxes. So I didn't account for that in my initial pro forma, and that's a few $100 a month is a decent amount when you're talking about a 12 unit.
Yeah, so you're dealing with some tight margins there at that size.
Yeah, absolutely. Yeah, so things like that, and I learned. I'm like, okay, well that's going in my pro forma now in the future. Something like accurately figuring out what the taxes are going to be based on the millage rate and the SEV, or the state equalized value or taxable value.
Yeah, and the fact that all that becomes uncapped upon transfer, which means
absolutely.
whatever it is for the seller is not necessarily what it's going to be for you. It's going to be a lot more.
Exactly.
In some cases.
Yeah. On this last property we bought, this 96 unit, the taxes were $100,000 when we closed. The sellers had owned it since 1977 when they built it, which, there's a cap on how much they can increase taxes every year when you own it. And if somebody's owned it for 40 years and it's never been uncapped, you can expect a big increase. And so our taxes, and hopefully they don't record it. Sometimes it slips through and they don't record it for an extra year or so, but they're going to be going up $240,000 approximately. So it was a huge increase.
This is a different property, right? Not the 12
This is the
unit.
96 unit.
Okay.
Yeah. Yeah.
I'm like,
exactly.
wow, that's not a 12 unit.
No,
I don't know if you
no.
can afford anything else.
Yeah.
Wow.
So you just have to, and you can take courses on it, but and I do try and educate myself, but a lot of it I've learned from experience and just doing it.
Well, let's take that experience, and you brought a top 10 list with you.
I did, yeah.
Top 10 on successful syndications. Why don't you set it up for us, and let's get into it.
Cool, yeah. So I was thinking, guys, before I came on this, how can I take, I'm young, I haven't been doing this for a long time, but I think I have gained some valuable experience and learned some lessons from what I have done so far. And how can I take, from me being a beginner, teaching it to some other people who haven't done this before? What are some of maybe the 10 best things I can teach you guys? So these are 10 tips on a successful syndication. I don't think they're in any particular order, but I want to just run through them, and let's, feel free to stop me and ask me questions on them. So number one here was use your best deal structure up front and don't change it throughout. Once you get under contract, don't start changing your deal structure around and pitching different things to investors. So what I mean by that is when we were talking earlier about the 8% preferred and the 80-20 split, put your best foot forward up front, especially when you don't have a big track record, and start with that. So what we did, and why I bring this up, is we learned from experience. We made a mistake on our last deal, this 96 unit. We started with an 8% preferred, and I think it was 70-30 split, except that 70% on top of what the investors were getting actually went towards paying down their capital accounts. So, every year they get their 8%, and then their 70% split, that excess that they get, went towards reducing. For this deal, it was $1.5 million was the equity raise, so it went towards reducing that, and
so it was reducing the principal that was
exactly.
Mm-hmm.
And investors did not like that. That was not, because that's not considered profit.
That's not a real return. They're just getting their money back.
It's not a real return.
Yeah.
And we thought, oh, this is awesome. We'll be able to pay them, pay their capital down. This would be great. We still thought, oh, this is a good win-win scenario. We'll get them a bigger chunk of profit at the end when we refi or sell, because there's less capital to pay back. But no, guys, it wasn't the case. We ended up losing a lot of people. That really, once we changed it to the right structure, which we ended up raising for, we couldn't go back to those first people. We had already lost them. We'll try again on the next deal, but we lost them. So start with your best foot forward up front. Don't get greedy. Do it right and stick to what's standard.
Great.
So That's number one. Number two, prep investors months in advance. So, Brian, I'm sure you would probably agree with this. Getting good, strong investors, accredited investors, is a long-term play. You're not going to meet someone. It's not common that you're going to meet someone and within a week they're going to cut you a check for for a syndication. It doesn't really work like that.
No,
I would say
it's a long-term relationship.
Yeah, 100%. I mean, you need to start months in advance prepping them. Send them an example deal. Tell them, hey, this is what we're looking for. This is the type of deal. These are the types of areas we look for. These are the returns you can expect. And when I bring you this deal, Mr. Investor, Mrs. Investor, if this is something you're interested in, this is what I'm going to bring you. And I hope at that point you're going to be able to act quickly so that, we can get through our short due diligence period, right? So, and raise the money in time. So that's what I would say. Prep your investors in advance. We did not do that. We went from 2 12 units where we raised $150K in each of those to having to raise $1.5 million. And that is not a small jump. And for us, that was a huge kick in the butt. And we learned a lot. Eventually got it done. We finished it, but if we had started by prepping them in advance, using that right deal structure up front, it would have been a lot easier.
Sure. Yeah.
So
eventually we're able to raise that amount.
Yes. Yeah. So, but make it easier for yourself. Make a list right now. If you're looking for syndications, don't, and part of the reason this happened was we always thought like a good deal sells itself. Right. And we got, basically, not to get too deep into this deal we just did, but a guy had owned it for 40 years. Like I said, he owns about $1 billion in real estate, and he's getting rid of all his C-class multifamily to move it into Class A stuff. We met him. He really liked us. He threw us a bone on this. We got it for 44 a unit. Right now it would sell as is for mid-60s a unit in this market. It's in Southfield, Michigan. It's an awesome rental market. We got lucky finding this from prospecting, but we thought it would sell itself. We thought having a good deal would just, everyone's going to want to do it. But that wasn't the case. So prep your investors.
However, let me just add to that. You don't want to prep them too soon, because you want to make sure that there's a very good chance it's going to move forward, because if you prep them and then it doesn't happen, that can hurt you there as well with your investors. Yeah,
no, absolutely. Yeah, no, that's true. That's true. You want to make sure, it's not, when I say prep, it's not like a serious, you're not getting them on like a capital call, but you're basically saying, hey, like if you're interested in these types of deals, this is what we're doing. This is the type of returns we'd like to provide. If I find a deal like this is what I'm going to approach you with. Is this something you'd be interested in?
Okay, so lay the groundworks for that.
Yeah, just build a relationship.
Rather than the specific acquisition, lay the groundworks for the type of acquisition.
Because you're dealing with people here. I mean, when we found out, we got under contract and we went out to our list of, let's say, 100 people that we'd found from either we'd written down from our network or online, sign-ups on our website for saying they're interested in syndications. And you'll talk to people and, half of them might say, something's going on right now, or I just spent the $50,000 I was thinking about investing, or I've already invested it, or we had a guy that had committed $250,000, and we were under contract, and his daughter, he just learned that his daughter had gotten cancer, and of course we gave him his money back. Of course, we're not, I've never forced somebody into a deal. Life situations, situations happen, things come up, you're dealing with people, timing is everything. And if you're just bringing them up a deal and expecting them to cut you a check within 30, 60 days, you're going to be hard pressed to find that on everyone. So if that makes sense.
Yeah. Good advice. What are we on? Number 3?
Yes, number 3, don't send confusing info to investors. I love Excel. I consider myself like an Excel whiz, but I will never again send my entire pro forma to investors because it's too confusing. There's too many numbers, too much information. It's good for us to analyze, but like you were saying earlier, Brian, you just keep it simple. Keep it simple. Create a one-pager, maybe a simple pro forma, and some details. Send it to them if they're more interested. Goes on to my next point. Number 3 was just to create a one-pager. Number 4, your deal package should probably be 5 to 6 page summary, kind of like, a PPM that has all the details, some, a photo or two, details on yourself, the sponsors, and your experience, details on what returns you expect to provide, stuff like that. So keep it simple with maybe a one-pager and then some that's a little more detailed.
Yeah, I always do a 5 to 6 page teaser package.
Yeah.
Which is exactly what you say. A few photos, some terms of the deal. How much what are we going to acquire it for? How much are we going to try to raise? What's the benchmark returns that we're shooting for? Whether it's an 8% return and 15% annualized return or whatever it may be. But I keep it simple and I keep it to 5 pages, and I make sure there's a map, kind of a map of the state, so you know what state it's in, and a map of the area, so you can see where it is in the area. And I make sure there's photos, because people love to look at photos, and links to Google, Google Satellite and all that.
Absolutely.
But, I do that, and then later, once I know that things are moving forward and we're putting together the private placement memorandum, I create a much more informative property package that's probably 20, 30, maybe 40 pages, depending on how much content I have to put in there.
Yeah, no, that's smart. I mean, you can't reel them in by giving them too much data. They're going to get overwhelmed. And on this point number 4 as well, my note was, don't send them a Dropbox link with all the details in different folders and expect them to be able to figure it out. They're not sophisticated. They're not always sophisticated investors. They don't want to see, a lot of the due diligence items or all the pro formas and, not even up front. They don't always want to see the PPM and operating agreement right away. They just want details on what they're going to be investing in. I mean, guys, you got to think this is a lot of times too, it's emotional for people, for investors. They want to see the pictures. They want to see, what am I going to be a part owner of? They're going to be a part owner of this deal. They want to know that. So you got to tease them and not give them too much up front. That was a mistake we made, and we had a lot of people on our list that we sent. We said, here, check out the Dropbox link with all the details, and left them to fend for themselves. We'd follow up, and lo and behold, half of them didn't go through it because it was just too confusing.
Yeah, well, people just don't have time. They don't have time, or they put it off, and then they keep putting it off. There's a time and a place for certain investors to have a Dropbox link and to get all the information. Certainly if they want to see more information, absolutely. But as syndicators putting together this, you're marketers, and you have to control the information that goes to your investors and simplify it so that they could look at it in 10 minutes and say, I want in, or I don't want anything to do with this. But make it so that their first exposure to the deal is something that they can get a 5 to 10 minute look and be know if they want to move forward.
Absolutely. It's marketing 100%, like you just said. So that was a big F up on our end. And we ended up halfway through, we're like, what are we doing? We didn't even realize it until we started talking to people that just didn't even open the link or whatever, and it just didn't work. So we put together, a one pager and then some like 5 to 6 pages, and that started working a lot better. So point number 5, lay out a specific system in advance for your investors in terms of filling out and signing the required documents, PPM, operating agreement, the questionnaire for accredited investors, and then a timeline for when they have to send in funds and how they do that. So a mistake we made too was we weren't on top of it enough with we got the document signed and everything, and then we still had time left in our due diligence period. And, we had a 60-day due diligence, 60-day closing, so we had some time. And we didn't get on everyone enough to get the money in quick enough. What I would say would be important would be to tell investors. So the next steps from here, if you're interested, would be to sign the PPM, the operating agreement, this investor questionnaire to prove you're an accredited investor. And then within 2 to 3 weeks of that date, you have to send us your capital into either as a brokerage, we have our own escrow account, or if you're more comfortable, you can hold it in escrow with our title company. And then you're not waiting around and having to bug people again, for money in a few weeks because they haven't sent it in or they gotten busy, and just, you want to get them on a good system. And just tell them this is how we work. You've got to sign the docs and get the money in within 2 weeks, unless you need some time to set up a self-directed IRA or whatnot,
Yeah, and I one of the statistics that's thrown out is that half the people who say they're going to invest will not invest.
Absolutely, it's probably more than half, to be honest, Brian.
Yes.
Probably more than half.
So you want to have your money ready to go, in the bank and ready to go at least a couple of weeks before you close, because you're going to run into that, and you may have to scramble in those last couple of weeks to find more money. But it also helps when you're talking with your investors to say, look, your investment is not guaranteed that you're going to be able to buy a unit or a share in this investment. It's a first come, first serve investment. So if you wait, there may not be anything for you to invest in, because it might fill up a lot quicker than you think.
Oh, absolutely. And that was my last point, and we'll get to that, is you need to raise more than you think, because people drop out all the time. They'll tell you they're interested, and then it happens.
Well, yeah,
especially with people you haven't worked with.
Let's move that point up to here, since we're talking about it. Yeah,
absolutely.
People will drop out. People will say, "Oh yeah, it's on my desk. I'm gonna sign it tomorrow and get it to you," and then you never hear from that person.
Oh
again.
man. I mean, I can't. We had a guy that had signed the agreements for a $500,000 investment, and he pulled the plug on the last minute, and he created some BS excuse that, there's something he didn't like in the operating agreement. He wouldn't explain it. And he was like, I'm pulling out. I'm not, and it happens, but you're expecting people to come through, especially with such a large investment, and they pull out, whether he had the money or not, I don't know. That might've been a reason, but, it happens. So what I would say is always raise extra money, and do not count on anyone being in the deal until you have a check in your hand. You do not have that equity raise finished until you have a check in your hand for the entire amount, or from various investors for that full amount.
Absolutely. And so, if you're listening to this and you are an investor in other people's syndications, or you're looking at other people's syndications, please be willing to say no, because so many people just don't want to say no, and they're like, oh yeah, I'll do it, but they never intend to do it. I would much rather hear a no, thank you, but no, than oh yeah, I can't wait to do it, and then no follow.
Yeah, no, I mean, seriously, tell me no, and then tell me why this doesn't fit for you, and then tell me what will fit for you, so I know not to bug you in the future for a deal that's not a good fit. I don't want to bug you. I don't want to waste your time. I mean, we're not here to be salespeople and convince people into a deal they're not comfortable in. We're here as sponsors to provide an investment vehicle for people that are, have an appetite for real estate, that have an appetite for cash flow, that want something different than stocks, that want a different return than you might get from stocks or a mutual fund. And we're just basically, helping you guys along that process as passive investors, to put your money in a different, different avenue. So if you don't want to do it, that's your choice, So
just say no.
Like you said. Just say no, please.
Just say it, please.
Save us both the time.
Yeah, don't make me chase you. Don't make me try to call you.
Don't make me chase you.
Just say no. That's the best thing you can say if you don't think you're going to do it.
Yeah, definitely.
What else you got for us?
So that'll go on number 6. Well, I guess that's actually a good point. Let me skip ahead a little bit. Keep in close communication with the seller if it's an off-market deal. So this for us was an off-market deal. Luckily, we had, like I said, I've already mentioned the 2 biggest pieces. We had somebody that was in for $250K, he said, and we gave him his money back because, like I said, his daughter had cancer. Something came up. We weren't going to hold somebody to that. That's not a good way. Even though it says in the operating agreement, once you put your money in, it's in. that's not the type of reputation we want to build. So we gave him his money back. The other guy that was in for $500K pulled out. We had a really good rapport with the seller because I called him every single week, probably 1 or 2 times, just to keep him posted on what was going on. And this is the least of his worries. He has $100 million in senior living projects being developed right now. He owns $900 million in other, pieces of real estate, multifamily, whatnot around. But I made it a point to bug him and to build a good rapport with him so that if something came up, we could get an extension. And that came into play here where we had investors drop out. And I called him up. I said, hey, we need 30 more days. I'm sorry, but we had some investors pull out, and I was just straightforward with him. And he's like, that's not a problem with me. It gives me more time to find a 1031 property. So, build a good rapport with the seller, or, if you're working with a broker, build a good rapport with the broker and just be honest, straightforward. If you need some more time, they'll be more willing to work with you if you're being honest than if you're trying to just pull a fast one on them.
Yeah, absolutely. So, and brokers and sellers, they can smell it when you're getting squirrely. So don't get squirrely. Be straight and honest.
Do not get squirrely.
Yeah.
Yeah.
Because
I love that.
You will lose all credibility if you get squirrely. But one thing I build into, or I like to build into my contracts, my purchase agreements, if possible, is an extension period where if I go hard with a certain amount of money, maybe double the whatever the earnest money deposit was, I can buy an additional 30 days in the event that the financing is not ready.
Okay, yeah, that makes sense. Yeah. I mean, you could always put in an extension, or even like if you're in due diligence, you could say, for an extra $25,000 hard, we get an extra 30 days or something like that. I mean, you can always kind of, conform it to whatever you guys need.
Yeah,
so
that
that's a good
shows
idea.
You're serious because you're putting real money on the line. You're going to close. You're just delaying it. That's all.
Yeah, exactly. And people are willing, for the most part, they're willing to work, if they're reasonable. So that was that point there. That was, I would say, number 6 or 7. Jumping around here. Let's see. So the next one I have was do not bootstrap, and please do not do this. Do not bootstrap legal work. We had a team of attorneys that we had worked with for all of our single family transactions. Like I said, my partner had been doing that for 10 years. We did a ton of deals. We had title attorneys. We had probate attorneys, foreclosure attorneys that we worked with. We had an attorney that was not a multifamily or not a syndication attorney work on this deal. And it was cheaper. We spent about $3,000 to $4,000 on the deal. And there was a lot of me going back and forth with them, working on the PPM and operating agreement to update it myself along with them. Don't do this. Spend the extra money. It might cost $10,000 to $14,000 for a bigger deal to get the whole PPM operating agreement, and they'll also work with the lender, work with title. They'll cover the entire transaction, do everything for you. Hire someone experienced, pay a little more money. I promise you, it is worth it. Do not work with a cheaper attorney to save money.
Yeah, absolutely. When you're syndicating, you have to create a private placement memorandum. You need to have the proper subscription agreement, the proper operating agreement. It's a very complex thing. You need an attorney who understands SEC rules and guidelines and how to put these private placement memorandums or PPMs together.
Definitely. I mean, you need that, and it also comes into play working with a lender. We had an issue that came up because we didn't have a dedicated attorney being our liaison on this deal. We had someone that was like, hey, we already had a PPM and operating agreement from our past 2 deals. So it was like, hey, we want to make some changes. The investor would like kind of this change, or can we update the PPM and OA in this way, and whatnot. But we didn't have a dedicated liaison between us and the lender either. So there was a lawsuit that was pending between the tenant at the property and the previous seller, their company. The lawsuit wasn't attached to the property. It was between the tenant and the owner's entity, right? So when it came down to it, and we were expecting a close at the end of August, We were about 2 weeks out from closing. I'm talking to the lender. Hey, is everything okay? We're good for closing. They're like, yeah, everything's fine. Everything's okay. And this was a Freddie Mac small balance loan. So this is an agency loan. And what happens is they put the whole package together. This was with Hunt Mortgage. They put the whole package together for Freddie Mac. Then they get it from, Hunt Mortgage is kind of like the lender, where Freddie Mac is the person who does the final underwriting. They put that package together, gave it to Freddie Mac, and then Freddie Mac says, hold up, there's a pending lawsuit. We're stopping everything. You guys can't close till this gets figured out, till this gets settled. And that ended up pushing closing back another 3 weeks. We had to go get another extension from the seller, which is not something I wanted to have to do again. And they basically told us, Freddie Mac at first, they said, you guys, we won't close this deal. There's too much risk having a lawsuit open on this property. And it was crazy because we had dealt with a lot of this stuff before in single family transactions. And there's no way that us as a purchasing entity buying this property would ever have this lawsuit come back and get attached to us, not to get into too much legal work or legal information, because the lawsuit was between the tenant, which is a former tenant, and the seller's entity. So Freddie Mac was being just overly conservative. We ended up bringing 5 or 6 different attorneys in, got all their opinions, sent them all to Freddie Mac, pushed extremely hard, and we got them to allow it as long as no lis pendens was filed between. There was like a week period between when they said they gave us that final commitment and when we closed. And they said if a lis pendens gets filed within this 6 or 7 day period, you guys are losing your whole 2%, your 2% good faith deposit on this loan. So it was a little bit sketchy going into that, knowing that we had that 2%, which was about $64,000 plus our $100,000 hard because we're in the closing period now on the deal with the seller. $160,000 on the line if a lis pendens gets filed in this 7 day period. But we were confident enough that it wouldn't happen. But if we had a good lender, to go back to my point, if we had a good lender, that never would have happened. This would have gotten squashed up front. It would have been a non-issue.
You mean if you had a good attorney?
A lender, good attorney. If we had a good attorney, that issue would have been squashed up front. So don't do what we did.
Chances are an attorney who is skilled in syndications and does them all the time is perfectly capable of dealing with agency type loans. And, because that's the type of investments he's doing syndications for, where agencies are being brought in, Fannie Mae, Freddie Mac, that type of thing, and is going to know how to navigate that sort of territory. So I don't know if this is on your list, but definitely having the right type of attorney for the deal you're doing and the different components of that deal is very, very important.
Look for a real estate specific attorney that deals with real estate transactions, commercial transactions, and that has done syndications before. Most of the experienced ones will be knowledgeable about it. So find someone that knows that. Hire them, pay them a little more money. It will save you a headache and possibly $160,000 if it comes down to it. So that is my advice. I hope that was explained clear enough there. So,
oh yeah. What else you got for us?
So this is a quick one. Reach out to your lender on day one of due diligence. Get them started on their work. Ask what they need from you. Get them all the information. Get them going. Tell them what your time frame is for due diligence and closing. Don't wait. Some people think that you've got your 60-day due diligence and then a 60-day closing. I'm just going to wait to approach the lender once we hit that closing period, or maybe it's 30 and 30. But just approach them day one of due diligence. And get them all the stuff you need. Get them prepped. Get them ready to go so that you don't have any hiccups.
Yeah, and don't assume that your lender is on top of it, because sometimes they're not.
Yes.
And be responsive. When your lender requests something from you, get it to them as soon as possible.
Yeah, absolutely. Get them to them as soon as possible. Get them everything they need. Stay in close. My next and last point was stay in close communication with them and settle any issues early on so that you don't have to be worrying about them near the end of the deal when it's coming down to the wire. So those are 10 tips. Hopefully they save you guys a lot of trouble where we had some trouble on these last few deals we did. Now knowing these, I think we have a lot of corrections we're making going forward, and hopefully you guys don't make any of the same mistakes on your first deal that you do.
Well, I think definitely after listening to your list, anyone listening to this will just do a perfect syndication.
I think so.
No mistake.
I think so.
How can you make any
I think
mistakes?
so.
Those are pretty thorough.
How can you make those are the biggest ones? So, and I'm sure. I mean, this business is about learning, educating yourself, and a lot of that comes from making mistakes. You can read, all the books in the world you want, listen to all the podcasts. You're going to learn it by doing it. So, go out there and don't be afraid to make some mistakes. Don't be afraid to have to deal with issues. The more money you want to make, the more problems you're going to have. More money, more problems, as they say. So, don't be afraid to tackle them head on. Great.
Well, David, thanks so much for being on the show today. I mean, I think this has just been a fantastic conversation about syndicating, especially when it comes to apartments and multifamily. It's certainly impressive that at your young age, you're motivated and driven enough to have built a portfolio as the way you have. And I really appreciate you taking the time to share your experiences with us. By the time this episode airs, chances are you'll have your podcast up and live. So I would encourage people to listen to it. It's the Borland and Toupin Real Estate Investing Podcast.
Correct.
If anyone wants to get a hold of you, how would they do so?
Yeah, so you can go to our website. That is theborlandgroupllc.com, or you can just Google the Borland Group Michigan, and it should pop up. That's BORLAND. Or you could find us on Facebook. My name on Facebook, I believe, is at the David Toupin. David Toupin was taken, so I put the in front of it. So that is a way to find me there. Instagram, you can look me up. I'm kind of all over social media and stuff like that. So, those are good places to find me.
Great. Well, thanks for being on the show, and I'm looking forward to being on your show soon as well.
Beautiful. Awesome. Well, thanks again so much. I appreciate you having me on.
This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And Point Central, the leading provider of enterprise-scale smart home automation for short and long-term rental property managers. Learn more at pointcentral.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.